thank you very much. So as you all know, I am Ashley Murphy, the founder and principal of Arete Wealth Strategists. Today's presentation is on downturns and recoveries, what's going on with inflation, interest rates, and my portfolio. So do keep in mind, this isn't personal, this as a general presentation isn't personalized advice, but of course I do provide personalized financial advice to you all. Okay, so what are we going to be covering? First, we're actually going to do a little bit of a diversion into a slide deck a different slide deck that I prepared. And then we're going to come back and have a look at the current situation with inflation, anticipated inflation, what we see happening with interest rates through the rest of the year as a means that the Federal Reserve and other central banks around the world are using to combat this problem we're having with inflation. Historical stock market declines. I got rid of the recession indicators, actually, so we won't be talking about that. Economic and market outlook scenarios will round up the presentation. But let me just swap decks over to this one, because I figure this is helpful in bringing us up to speed with what's going on right now. So here we have the S&P 500 brought back to about the last 6.5 years. So here's where we are today. You can see from the November 2021 peak, we're down 17.9% year to date. And that is as of Friday, that was current. So June 24th. So that's current. So it's been a pretty broad market decline. Here's what we've seen. It's unfortunately been a case of rising interest rates, which leads to a decline in the bond prices and equity prices. So pretty much everything is down except for commodities. We'll talk about commodities a little bit more in a moment there, and what we don't like about commodities. Volatility. This particular chart we're looking at is to do with the VIX index. VIX index is an indication of how much volatility there is in the market. And what's interesting about this is this decline, as we saw back here, while there's certainly been a negative trend line, no question of that, it's been a negative trend line without a great deal of volatility, without a whole lot of surprises. It's been this gradual decline. It doesn't make it any better, and I share my clients' disappointment with what's going on, but I'm trying to describe the nature of the downturn that it's occurred here. But it's important to keep what's happened in historical perspective. And so let's have a look at the S&P index rebased over different periods of time. So you see this top graph, this dark blue, going back to 2019, we're still up 56%. Since COVID-19 peak, we're still up 15.5%. And since the January peak of this year, we're down 18.4%. So the point here is investing is a long-term undertaking. Global stock market performance over similar periods of time, over the prior 2 years, excuse me. So the US has done a lot better than the rest of the world, where you see developed markets, even over that 2-year period, are only up 5.3%, and emerging markets up 1.2%. There is a silver lining on this cloud, though, that we'll see a little bit later, with expected returns having been boosted significantly as a result of these declines. Now, I was saying a moment ago, when we're looking at year-to-date asset class performance, the only major asset class that's up is commodities. So what's in commodities? This is where you'll find your energy, your precious metals, your coffee, your wool, those sorts of things. Those are collectively referred to as commodities. Now, the reason I am not fond of those in a portfolio is they are volatile. From one year to the next, it bounces around like a ping pong ball. So you see the bottom performer in 2006 is near the top in 2007, in the middle, but still down 35% in 2008. I don't care for middle returns, but still negative 35%. Towards the bottom there in 2009, did participate in the recovery, but not that much. Still recovering there in 2010, towards the bottom for a good, a 5-year stretch. Bit of a rebound there in 2016, bottom in 2017, negative 11.2% in 2018, bottom in 2019. So you get the picture. it's a very volatile asset class. And so I tend to be a little bit leery of it for that reason. So let's swap back to the prepared slides, and we can get into this. So current inflation, what's going on? Well, really, we're seeing a late stage cycle occur with labor costs. So what's happened in the past couple of years? Well, we couldn't work. There was a global pandemic. People were staying at home. Suddenly, and the economy was pumped full of stimulus. As a result, people purchased goods predominantly. They couldn't purchase services because they couldn't travel or go to restaurants or shows. So they purchased goods. The ports got blocked up. The ships weren't shipping as much. And the people in the warehouses weren't working. So there was inflation there first on goods, which drew down inventory. Then suddenly workers got wind that there was all this, and the economy at large got wind that there was all this demand out there. And in fact, despite the pandemic, it looked as though economic figures were holding up remarkably well. So what's happened is we've seen, as a result of other external events, namely what's going on in the Ukraine, but also just the return of workers to the office has driven up energy costs significantly. So that's gone up. And consequently, this is the late stage cycle of inflation I'm referring to. Now people's expectations have become anchored that, hey, I want to buy that thing now because it's going to be more expensive if I wait into the future. And by the way, if I'm talking to my boss tomorrow, I'm going to say, we need to be thinking about a raise for me that's in excess of, the usual 2% or 3%, because haven't you seen the price of gas? Haven't you seen the cost of what it costs to take a flight these days? These things have gone up significantly. So the tool that the Federal Reserve has to put that genie back in the bottle is interest rate increases. And they have been coming hard and fast. We saw the sharpest increase in close to 40 years just earlier this month. There's 0.75% increase. So now we're finally seeing savings rates on bank accounts and CDs ticking up. But the idea is raise it so high that companies say, I'm not going to do that project. I'm not going to invest in that thing because it just costs too much money. The risk of it going south is too great. And finally, people catch on and say, oh, I get it. We're not increasing prices anymore. Now, I think an exception to that could be with house prices. Interest rates go up. We're already seeing it on Zillow, the number of house price declines in the previous quarter, and in Australia, and it's actually been happening since the beginning of the year, but it's taking off in other areas. Energy prices, top performing sector is the only sector in positive territory, as you heard me say earlier. And same with this other comment that I made earlier. We have some other possibly significant rate rises coming before the end of the year. I've heard as high as 3% at the federal funds rate. So what banks can borrow from each other at, which is going to drive mortgage rates way up, which will hopefully damp this inflationary problem that we have. Okay, so what about, speaking of inflation, what do we see here? So yes, Antonio, that is what I said. Depends on what part of the country that you're in, but here in Minnesota, we're seeing them dropping. And then also I was just watching about 3 weeks ago, I was just watching an overview of the Australian economy, and we've already seen those declines only in Sydney and Melbourne. Brisbane, they're not forecast to happen, and I don't recall the other major capital cities. So inflation forecast, it's expected to peak in the second or third quarter this year. I'm pretty confident that the Federal Reserve they're keeping a very close eye on it, but it's really no surprise if you look at the money supply, what has happened, where so much money was pumped into the system a few years ago, so much demand was created, so little supply was fulfilled, and this is what happens. It's, prices go up as a result. Okay, so thank you. Look at that, Ryan. Thank you, like a personal researcher here, providing that link. Thank you. Okay, inflation expectations. Now let's keep in mind how this rates historically. So what we have here, thanks to Morningstar and their stock bonds and bills index series, is we see that of 22 market declines going back since the Great Depression, actually, 1892, we see so far this has been the mildest. Now that, like I've said before, that's cold comfort to anyone nursing portfolio losses, but we think this is going to turn around by the end of the year, and we're optimistic as to the direction of where things are headed. Okay, so there's a little side conversation going on there. All right, anticipated effect of rising interest rates on the economy in your portfolio. It really has been an unfortunate correlation of events with interest rates increasing at the same time, because as many of you will have heard me say before, the thing with interest rates is that they're negatively correlated with bond prices. And so interest rates go up, bond prices go down. And so the particular correction that we're dealing with right now is one that has been caused by bond prices, by inflation rates going up, which has brought down the frothier, growthier stocks in particular. There's been a return to value. Growth has been outperforming in this current market cycle, which you could say commenced back March 9th of 2009. Growth has been on a tear, but boy, has that turned around in the past 18 months, where value has now been outshining growth. I don't think it has as of yet surpassed the growth premium that we've had in the entire market cycle, but it is validating. It is a return to historical norms here. So the chart here is showing that what a 60-40, that's stocks to bonds, has done year to date, and sadly it's down about 20%. So we're seeing the S&P down about the same amount as a 60-40 portfolio, and that's because really bonds, which typically act as that ballast, the ballast meaning they're providing that corrective influence in a portfolio. Right now they're not. They're adding to what's already a sorry story. So it's deteriorated. The situation has deteriorated markedly. Lingering inflation has compounded some other unfortunate events in Ukraine and China, with them still pursuing their zero COVID policy, which is very localized. It's hard to say, when people use sweeping generalizations, because it really has been confined to big cities, but sadly, a lot of goods do come out of their big cities, so it is having a knock-on effect. And that third bullet point really says what I've been saying here, talking about the performance of that 60-40 portfolio. Wage growth is helping to a degree offset some of these rising costs. However, the full story is a little more complicated than that. I do have another slide. It's not, I can't show it right this moment, but it does show that inflation has outpaced wage growth. So what economists refer to as real returns have declined a little bit depending on the makeup of your spending patterns. So when we talk about inflation writ large, it's not reflective necessarily of everyone's experience. For instance, if you own an electric car and you don't commute, or you don't commute very much, then perhaps this increase in gasoline prices hasn't been felt so much in your residence. However, that's not to say it's not everywhere, because it is everywhere. Food has certainly been hit, and travel and services inflation as well. So that is a little bit of good news, is that as worker earnings have really kept up. So the base scenario that we see going forward looks like this. We think we've got confidence in the Federal Reserve. We think growth will slow significantly, and has slowed significantly in the developed markets. I have been on record as saying we are already in a recession, keeping in mind that recessions aren't called prospectively, they're called retrospectively. So the economists will come out and say, oh, that recession began in June of 2022. So I would say we may already be there. Expectations can be self-fulfilling, but I would say we may already be there, likely to be very mild. I think this is just a hiccup. It's indigestion, dealing with the money supply that came about from COVID. the money and the demand supplies and the lack of supply of inventory that came about from COVID, and we're still getting through that as well as it's not entirely behind us, but it's rather seeping into an endemic state. Okay, so downturn is short and shallow. I think that's what we're seeing. I'm very confident that that's what we're going to see. Hopefully it's not one of these worst case scenarios that you're about to see in a moment. Policy support helps to stabilize China's economy. Got a lot of faith in their Reserve Bank as well. COVID restrictions gradually ease. Inflation persists for a little while, but you'll see the expectation with, actually just going back a slide, sorry. I wanted to point to that inflation expectation. You see the peak inflation really hitting in Q3 of this, well, actually right now at the end of Q2, and then declining through the rest of the year. That's what we're expecting. Okay, so interest rates will rise actually rather quickly towards the end of the year, before things settle down next year. Equity markets stabilized despite earnings downgrades. I think they're already priced in, the incoming downgrades that haven't yet been announced, but are sure to arise. Growth stock valuations face further headwinds, i.e. get out of your FANG stocks and your Bitcoin and your fintech and so forth. Long-term yields gradually edge higher. That's a good news story there, with credit outperforming core government bonds. Okay. Worst case scenario. Well, this is what we don't want to see. So in this scenario, we see developed market. This is where everything hits the fan, so to speak. Developed market economies slow sharply as prices overwhelm the consumer. We have definitely not seen that as of yet. We see people still willing to take their summer trip. The average is a random metric to share with you, but miles traveled, gasoline consumption hasn't changed. We're hitting record highs. People don't care. They're just paying it and carrying on. So in other words, inflation has not broken the back of the consumer. The consumers are still sitting on very high historical savings rates coming out of COVID, surprisingly. COVID concerns and lockdowns are extended in this worst case scenario. They're extended in China. Basically, this is everything we don't want to see. Best case scenario, which is also very unlikely, which is why we have our base case in the middle there, faster than expected reopening in China. I don't know how that's going to happen, given I don't believe, I could be wrong, so someone, maybe Ryan, will produce an article to say I'm wrong about this, but I don't think they're pursuing a vaccination campaign in China. It's just, we're just going to lock everyone up whenever there's an outbreak. I think that's what's going on there. So we'll see how that works out for them. Commodity prices remain anchored. Not so sure about that. Potentially on the back of a de-escalation of the war in Ukraine. Just read an article this morning in this morning's Financial Times. They're saying the Russians are getting ready for a winter resurgence, but winter's a long way off in the Northern Hemisphere, so maybe we don't have to worry about that just yet. As a result, inflation falls back more quickly. So who really cares? The Goldilocks scenario is if everything goes well, then this is what we see happening. We don't think that this is going to eventuate, but it is the Goldilocks scenario. Now, here's the silver lining on all of this, is because of what's happened with asset price declines, which have been tough, I have been saying to clients that if you do have some dry powder, some spare cash, waiting to be deployed, now is the time. And I truly mean that. Look at this. So the expected 10-year valuation implied returns on international developed stocks were now at 6.7%. Emerging markets, 8.1. I mean, that's really something. That is in large part because emerging markets have not had such a great time with COVID. They've been really on the ropes as a result of that. So many of these asset classes are significantly increased with their expected returns over the next decade. That's what I have for you. I want to keep it short, sharp, and sweet. Any questions from the audience? Happy to open it up to hear if anyone has any questions. Oh, hi, Barbara. Hi, Liz. And James, welcome. Good to see you all. Look forward to talking with many of you very soon. Any questions, concerns, doubtful points, clarifications? Any other synonyms I can add for this? Well, you know what? Oh, here we are. Antonia, okay. Tell us more about emerging markets potential, please. You know, I will. I don't want to. It's funny that, so this is one of those things I think that the clients that have known me a longer time maybe can read more into my tone. The thing with that, let's go back to that slide for a moment, shall we? The thing with emerging markets is, emerging markets have done incredibly well. They did incredibly well throughout the early 2000s, the first decade of the 2000s. You should be able to see that questions screen again. I'm going to go back to this quilt, as some people call it. So what do we see? Emerging markets, we're doing EM is emerging markets. So absolutely killing it in 2006 and 7. Really fell off a cliff there in 08. And then this is where they've been for the past decade. Look at EM. If you see that pinky tan colored tile there, really down with commodities. So I'm a little bit leery of that expectation. I still have an allocation to emerging markets in large part because I'm a believer that they will return. But I think geopolitical events of the past couple of years have really, I guess, shown me that it's not inevitable that everyone, reduces corruption and economic development just happens like it's a foregone process. It's not, and I've been a little bit sanguine about my expectations there. So my allocation to emerging markets is not increasing despite that number, Antonia. So I'm still staying towards developed markets despite that attractive valuation implied multiple you saw there. Elizabeth, great chat. Do you know if there is a cap on how much capital losses we can claim at tax time? There's two answers to that question. Yes, three answers. Yes, I know the answer to the question. Two, the answer is against ordinary income is not much, $3,000, and short-term and long-term capital losses are effectively allowed to roll forward indefinitely in the US. And actually it's the same in Australia, but there's no deduction against ordinary income in Australia. So $3,000 against ordinary income, and otherwise it's going to roll forward. Aaron, hi Aaron. Any guess on the timeline of the downturn? Are we talking 6 or 12 months or more? I think, so here's the thing. I'm always careful about saying this, and that is the economy and the stock market are not the same thing. The economy and the stock market are not the same thing. In fact, I divvy up, I have two different presentations that you see here. There's the market update and the economic update. And the reason they're separated is because they are two different things. The stock market is happening in real time. Things happen so quickly, and it's based on expectations. So in other words, these declines that have already happened are based on what we think is going to happen next. The things that happen next haven't yet happened, of course, because no one can see the future. So I am not especially bearish from where we are today. I don't think we're going down much more, maybe a little bit, but I think we're mostly there, in large part because a lot of the fundamentals are still very, very strong. In fact, I'll wander off script. It's very dangerous to do that, but I'll wander off script a little bit and just show you another thing that does give me some confidence, and that's the S&P earnings per share. Look at that. So what do we see here? We see a stock market decline based on expectations of, hold on a minute, inflation's getting out of control, Fed's raising interest rates, surely this is going to slow the economy. It probably will. You heard me say it. I imagine we may already be in a recession. But the earnings per share, as per the most recent data that we have on that, which is very recent, is still showing record earnings per share. So companies are selling more at higher margins. They're making more money. So the fundamentals there are very good. Shiller PE ratios, now that's a different metric altogether. Global equity valuations, US is still, this kind of plays to Antonia's question from a moment ago. So the US is still, you might say, richly priced compared with an emerging markets. But I would put it to you, just to play it both ways here. The US is a more developed, obviously it's a more developed economy, but the economy itself is more sophisticated. So it's an information economy. In the pre-1990s, what are we looking at? Who are the blue chips of the S&P? They're the General Electrics, the Exxon Mobils, they're the 3Ms, you know, the companies digging things out of the ground, extractive industries, making things, physical products. Now, what are we talking about? We're talking about, well, I hate to use that word again, but the FANGs, the acronym, that's what I was looking for. Sorry, the acronym again, but the FANGs, we've moved to an information economy. If you look at emerging markets, they don't get these higher multiples because they don't have Microsofts and Googles and so forth in there. So that's, I think that could actually be a structural difference, the reason why we're at 15.9 versus 11.1 in emerging economies. Also, the rule of law, less corruption, better infrastructure, et cetera, et cetera. But anyway, that was me getting carried away there. Making that point or trying to answer the question Aaron asked about what are we talking about. I think we're towards the bottom. No one can say with certainty, but I think we're hovering around the bottom. That's why I'm giving the green light to say, hey, if you've got extra cash, now is a good time. I don't think it's going much lower because it's not being induced by a negative externality. It's a positive externality. In other words, demand has gotten so great, inflation has risen. How do we temper demand? It's not a case of people's balance sheets just blew up because of like what happened in 2008, where suddenly, major players in the global economic landscape disappeared overnight. In the case of Lehman Brothers, the economic system wasn't shown to be a house of cards, as we saw with the subprime lending activity that was happening. What's happening is happening because of a good thing. Now, I don't mean COVID. I mean too many people with too much money chasing too few goods. Antonia asks, if we have spare cash now, where to invest it then? Well, that's the fine question, and it's really what you would expect. My answer to that would be my answer. I'm starting to laugh, Antonio, because it's the same answer every time. You know, it's sometimes I feel like a piñata. People give me a whack and I can drop a treat or a pearl out. In this case, I think the answer is in accordance with your goals. The way to invest it is to look at your goals in your client investment plan, see what's underfunded. That's where to invest it, because the answer is never, or I should say for my clients and my philosophy, more money is better than less money, just like more food and water is better than less food and water. But it's about match. It's like what they call liability matching. It's about identifying those goals, putting a time frame to the goal, putting a dollar amount to the goal, and then making sure that that goal is fully funded. Okay, that's my broad goal-based investing answer to the question. The rest of it, if you were to say, Ashley, that's very cute. No, give me names, give me tickers. I would revert back to actually a slide here makes the point. I haven't shown this one earlier either. And this is a broad-based slide. I'm going to start beating this drum a little bit more loudly in Q3. This is a slide you're seeing called asset allocation performance. Asset allocation performance. What does this mean? This is saying if going back to March 2009, you heard me say that was the market bottom of the current cycle that we're in. If we have selective amnesia and forget about Q2 of 2020 and COVID, but if we forget about this little decline right here, then what you would see is that if you were 100% invested in stocks, your total return would be 240%. If you said stocks make me nauseous, I really have a very low risk tolerance, the bonds, you would be up 54%. So my answer is greater allocation to stocks. And I probably wouldn't be any more specific than that, other than to say the risk category that we have, that the most aggressive portfolio we have, which is called aggressive growth, has an extremely high equity allocation because we just haven't seen a whole lot on the bond side to make us excited. So we're at about 92%, and that's spread between the US large cap, small cap, developed large cap, small cap, emerging markets, a decent allocation there. I think we're up around 17% in that aggressive growth portfolio. Infrastructure, that's ports, that's toll roads, etc. So it's kind of an equity-based risk off, if you will, like it's a diversifier. Same with real estate in there as well under the alternatives category. And then a tiny bit of fixed income, which is mostly floating rate, meaning when rates rise, so does the dividend paid by the particular holdings that we're invested in, or they have some other flexibility to be able to profit from a rising interest rate environment. Okay, that's Antonio's question. Next, Ryan. I have a bunch of cash sitting in an HSA. Should I just invest this in Bitcoin or something now? I would say definitely don't invest it in Bitcoin. Different people, intelligent people can disagree, but I'm not such a big fan of the technology. I don't know if that's the killer app necessarily, is currencies. I think smart contracts or something else is probably more where it's at. No, I would say the answer I gave Antonio is probably the same that I would give to you right there. Lively HSA, which is connected to TD, which will soon be Schwab, would be where you could go. And I think the equity allocation, put on that seatbelt, the roller coaster seatbelt, the one that goes over your head, keeps you firmly in place. There may be a rocky road ahead, but I point back to this. Look at the terminal value, at the terminal point, at goal attainment time, you end up better off with a higher stock allocation because stocks have got a higher expected return, and they have had so for the past 100 years, and it only stands to reason. I think that's everything. No more questions. I'll be happy to answer them or forever hold your peace. And I look forward to connecting with all of you shortly. I should mention, by the way, Kellen's wife is expecting to deliver in the next couple of weeks. Thanks, Liz. So Kellen will be out for most of Q3. So it'll be Amy and I holding down the fort, and we'll be doing our best to continue serving you. And thank you so much. Thank you so much for everything. All right, and have a wonderful rest of your day, be it towards the end of your day or towards the beginning of your day, depending on where you are in the world.